Welcome right back to The Explainer. Today, we're tracing the anatomy of a dollar. We're going to follow the journey from those physical coins jangling around in your pocket all the way up to the massive, kind of invisible economic levers being pulled by central banks. Look, whether you're just making a quick coffee run or analyzing national debt, the fundamental rules of money are exactly the same. So let's jump straight in and decode how this whole system actually works.
But first, I want you to really think about this for a second. When you hand over a $20 bill or, when you check that digital balance on your banking app, what are you actually looking at? Why does a simple piece of polymer, or just a glowing number on a screen, hold any real tangible value? We totally take it for granted that the barista will hand over a coffee in exchange for a tap of your phone. But why? Let's figure out what actually props up this entire system. All right, Section 1. The magic of money. To really grasp what money is, we kind of have to imagine a world without it. The fundamental problem with the old way of doing things, barter, is that it requires what economists call a coincidence of wants. It's like a frustrating puzzle. Say I have a bunch of extra wheat, and I really want some shoes. I have to find a cobbler who just so happens to want a whole lot of wheat. If they want apples instead, well, I'm completely out of luck. Money solves this brilliantly. It acts as the ultimate liquid asset. It's a widely accepted medium of exchange that completely eliminates the need for that lucky coincidence. But here's the thing. You can't just use anything as money, right? For a medium of exchange to actually work, it has to hit a few very specific criteria. First, it must be scarce, but crucially not too scarce. It needs to be standardized, meaning my dollar is exactly identical to your dollar. It has to be durable so it doesn't rot away, portable so you can actually carry it around, and divisible so you can make precise transactions. And beyond just being a medium of exchange, money also functions as a unit of account to measure value and to store value so you can hold on to your purchasing power over time.
Now, the really crucial point here is understanding the evolution of what actually backs our money. Historically, we used commodity money. Think pure gold or silver coins. This is money that has intrinsic market value. You could literally melt it down and sell the metal for other uses. But here's the kicker for our modern economy. Today's money is not backed by gold. No way. We use fiat money. This is money that is accepted purely by law. It doesn't have intrinsic value. It has value because the government declares it does, and honestly, because we all just collectively agree to trust it.
Moving on to Section 2, why we hold cash. So let's shift from what money is to how you and I actually interact with it every day. And this might sound completely backwards at first, but holding on to money actually costs you. Money itself provides zero return. If you're keeping your wealth stuffed in cash or sitting in a zero-interest checking account, you're incurring a very real opportunity cost. You are literally giving up the foregone interest or potential profits you could have earned if you just invested it elsewhere. So if holding cash costs us potential earnings, why on earth do we hold it at all? Well, economists outline 3 main motives for holding money despite that opportunity cost. First up is the transactions motive. You just need a stock of liquid cash to pay for everyday, predictable stuff like rent or grabbing groceries. Second is the precautionary motive. Keeping cash on hand for the unpredictable, a sudden medical bill or, your car breaking down. And third is the speculative motive. This is holding cash so you're ready to pounce on expected future changes in asset prices, like keeping your powder dry, waiting for a dip in the stock market to buy in. And the level of interest rates out there in the broader economy, that's the absolute key factor driving all 3 of these motives.
Okay, Section 3, counting Australia's money supply.
Now that we know why we hold money as individuals, let's zoom way out. How does an entire country actually measure its cash? It's not just one giant vault somewhere. We use cascading definitions for this. It starts at the core with the monetary base, essentially the physical currency held by the public plus bank reserves. Then we start adding layers. M1 takes that base and adds current bank deposits. M3 broadens it even further by adding other non-bank deposits. And finally, broad money encompasses M3 plus non-deposit borrowings. It's basically a cascading system that helps economists seamlessly track liquidity across the entire financial ecosystem.
Section 4, the price of money.
We know the supply. We know the demand. Now let's put them together to figure out how much money actually costs. This is where the macroeconomic magic happens. When we talk about the price of money, we're really talking about the interest rate. There is a downward sloping demand curve that perfectly maps the inverse relationship between interest rates and the quality of money people want to hold. When rates are high, people want to invest. When they're low, people hold cash. But the money supply curve? That one is perfectly vertical. Why?
Because it's independent of the interest rate. It's set entirely by the central bank. And right where those two lines cross is our equilibrium interest rate. That's the sweet spot where the market stabilizes.
But what happens when things get out of whack? Say there is an excess demand for money. People want more cash than is currently out there. Well, they'll start selling off bonds and non-money assets to get liquid. When everyone rushes to sell bonds, the supply of bonds spikes. That drives bond prices straight down, which forces interest rates to rise back up to that equilibrium point. On the flip side, if there's an excess supply of money, people take that extra cash and buy bonds. That new demand pushes bond prices up and, as a result, drives interest rates down.
Let's look a bit closer at the math behind that inverse relationship, because it's an absolutely foundational rule of finance. Bond prices and interest rates always move in opposite directions. Think about a fixed interest bond with a face value of $1,000 that pays a fixed 4% annually, so $40 a year, right? If the market price of that bond suddenly jumps to $2,000 because everyone is buying, that same $40 payout now only represents a 2% yield. But if the bond price crashes down to $500, that exact same $40 fixed payout is suddenly an 8% yield. The price goes down, the implied interest rate or yield goes up. Which brings us to Section 5, the Reserve Bank's role. So who exactly is managing the supply side of this massive equation? That's monetary policy. That's the official term for the actions taken by a central bank to influence interest rates, aggregate demand, economic activity, and ultimately prices in the broader economy. Depending on what the economy needs, the central bank can adopt an expansionary monetary policy to stimulate growth or a contractionary monetary policy to cool down inflation. They are the ones actually pulling the levers on that vertical money supply line we looked at earlier. Now in Australia, this role is filled by the Reserve Bank of Australia, the RBA, and they have a massive mandate. They act as the banker to the federal government, managing government debt, but super crucially for the day-to-day financial system, they manage the exchange settlement accounts for all the commercial banks. Every single bank has to maintain one of these accounts with the RBA to handle business with other banks in the government. And here is a strict rule. A bank's exchange settlement account must have a positive balance at the absolute end of every trading day. By controlling the conditions of these specific accounts, the RBA determines and enforces the monetary policy for the entire nation.
So, we've traveled all the way from the concept of a coincidence of wants in a barter system, right up to the RBA regulating overnight bank balances to steer the national economy. But this macro theory, it directly touches your own wallet. So I'm going to leave you with this to ponder. Take a look at your own finances right now. How are today's interest rates impacting the opportunity cost of your cash? Are they changing how you manage your precautionary savings or maybe your speculative investments? Understanding the anatomy of a dollar isn't just about abstract economics, it's about optimizing your own financial life. Keep that in mind next time you check your balance. Thanks so much for joining me on this explainer, and keep learning.